Most people believe silver will always lag behind gold, quietly following it like a shadow that never steps into the light. But there is a growing and unsettling mystery unfolding beneath the global financial system, one suggesting that silver may be gearing up for the most violent revaluation in modern history. And if current trajectories hold, the question isn't whether silver can hit $100 in 2026, but rather why almost nobody sees the forces pushing it there. To understand that, we have to zoom out and look at silver not as a commodity, but as a suppressed economic pressure valve waiting to explode. For centuries, silver wasn't the cheaper metal. It was money, the foundation of trade, the engine of early globalization, and the backbone of empires. Ancient kingdoms measured wealth in silver weights long before gold became a cultural symbol of kings. In medieval Europe, silver financed entire dynasties, paid armies, and determined geopolitical power. Even the Spanish Empire, arguably the first global superpower, was built on silver extracted from the mines of the Americas. Yet the abundance of that very silver became its undoing, because flooding the world with metal triggered one of history's first global inflation cycles. That was the first major twist in silver's story, when an empire rose on its back, and then unknowingly destabilized itself with the metal it depended on. But the real turning point came with the arrival of central banking, when powerful institutions decided that gold, not silver, would be the monetary anchor. This shift did not happen naturally. It was designed, argued for, and eventually institutionalized by people with enormous political influence. In the late 1800s, the United States committed what historians call the crime of 1873, quietly removing silver from the monetary system. Overnight, silver was downgraded from money to an industrial metal, a label that would shape its fate for more than a century. This decision was not accidental. It was the result of one of the most intense lobbying efforts of the era, driven by bankers who preferred a gold-backed system. A gold standard benefited lenders and hurt debtors. Silver, which inflated more easily, threatened their control over credit and monetary policy. And so silver began its long, slow decline in global influence, not because it lost value, but because it lost its legally defined role. But here's where the story takes a modern twist, because while the financial system abandoned silver, technology did the opposite. As industries evolved, silver quietly became one of the most indispensable metals on the planet. You can remove copper from electronics, nickel from batteries, even platinum from catalytic converters, but silver is irreplaceable in nearly every essential sector. From solar panels and electric vehicles to medical devices, water purification, and advanced computing, silver isn't optional. It's foundational. And unlike gold, which sits in vaults and jewelry boxes, silver gets consumed. Once it's used in electronics, it's often not recovered. It's lost forever, sitting in landfills or embedded in components too small to economically recycle. That means the world's above-ground silver supply is shrinking faster than any major metal used at scale. Meanwhile, demand is skyrocketing, especially in solar manufacturing, where silver is literally the heartbeat of photovoltaic technology. In 2023 and 2024, solar panels alone created record-breaking silver shortages, and the deficit hasn't slowed since. By 2025, the Silver Institute projected industrial demand surpassing available supply by a margin larger than at any point in modern history. But the real crisis begins in 2026, when new green energy mandates go fully live in dozens of countries simultaneously. Suddenly, billions of dollars in government incentives will push solar, EVs, and grid technologies into overdrive, all of which require silver. And this creates a new paradox. The world is trying to transition into a cleaner future using a metal they don't have enough of. Regulators know this, corporations know this, and governments know this, but nobody wants to voice it publicly yet. Because acknowledging a silver shortage means acknowledging a bottleneck in the global energy transition itself. and acknowledging that bottleneck would send prices skyrocketing overnight. But if demand is soaring and supply is shrinking, why hasn't silver already exploded past $100? The answer lies in the most controversial chapter of silver's story: paper suppression. For decades, the silver market has been dominated not by physical metal, but by something far more fragile: derivatives. Banks can sell silver contracts they don't actually have, in quantities far larger than the metal available in vaults. This means the price of silver is often determined by paper promises rather than physical scarcity. In some years, the ratio of paper silver to real silver has been more than 200 to 1. A system like that works only as long as people don't demand delivery of real metal. But beginning around 2020, something started to change. Large private investors and industrial users began quietly draining inventories. The London bullion market, COMEX warehouses, and even government reserves experienced continuous multi-year declines. By 2024, visible inventories had dropped to alarming levels. And by 2025, wholesalers were warning that sourcing large physical orders was becoming increasingly difficult. Meanwhile, investors began spotting discrepancies between physical premiums and official spot prices. In other words, silver's real price was already higher. You just couldn't see it reflected in the manipulated paper markets. This disconnect is the same pattern that appeared before explosive moves in other assets throughout history. When paper markets weaken and physical supply tightens, price suppression collapses from the inside out. And the moment that happens, revaluation is sudden, violent, and irreversible. This is exactly what happened with gold in 1971 when the U.S. detached from the gold standard, triggering a decade of massive price appreciation. The same happened with palladium in the early 2000s, when industrial shortages collided with financial mispricing. Silver is now positioned in a nearly identical setup, but with far larger global implications. Because unlike palladium, silver is tied to energy, infrastructure, technology, and national security. A silver shortage isn't a financial inconvenience. It's a structural crisis. And that crisis intensifies dramatically in 2026, when global solar installations are projected to nearly double year over year. Analysts predict that if current trends continue, the silver supply deficit could exceed 300 million ounces annually. To put that in perspective, that's more than the total annual output of Mexico, the world's largest silver producer. But supply isn't just shrinking, it's becoming more expensive. Mining companies warn that ore grades have fallen by over 50% in the past 2 decades. This means miners must dig deeper, process more rock, and spend more money just to extract the same amount of silver. Yet silver prices have remained too low for miners to expand aggressively, creating a self-reinforcing shortage cycle. Every year of underinvestment builds more pressure into the system, like a coiled spring that gets tighter and tighter. And once investor psychology shifts, once people realize how little silver is actually available, the flood of demand will overwhelm supply instantly. This is the hidden setup that makes $100 silver not only possible, but arguably conservative. Because if even a small percentage of gold investors rotate into silver, just 5%, the silver market is so tiny it would push prices into the stratosphere. And if industrial buyers begin panic buying to secure a long-term supply, the pressure intensifies even further. The coming surge in global electrification creates a scenario where silver becomes the oil of the renewable era, scarce, indispensable, and increasingly geopolitical. Countries that control silver production will hold strategic power similar to nations that once controlled fossil fuels. And nations that ignored silver, assuming it was cheap and abundant, will face painful consequences during their energy transitions. Every pattern in financial history shows that underpriced, overutilized, and structurally essential assets eventually reprice dramatically. And in the case of silver, that revaluation after decades of suppression, shortages, and denial may arrive faster, harder, and louder than anyone expects.